Sarah unlocks the door to her new home, feeling free, flexible, and financially brilliant. Her security deposit was small, her monthly rent is completely manageable, and if the roof leaks, it is someone else's problem. She looks across the street at David. He is moving into the exact same model of house. But David is not smiling. His stomach is in knots. He just handed over an $80,000 down payment, wiped out his savings, and locked himself into a 30-year mortgage that costs more than Sarah's rent. At first glance, it looks obvious. Sarah is winning. She avoided the massive debt, kept her cash, and bought herself total freedom. David took the expensive, stressful path, but 10 years from now, one of them will have quietly lost hundreds of thousands of dollars without even realizing it. And the mistake only becomes visible when it is too late. Let us keep this completely fair. Sarah and David both earn the same salary. They both live in the exact same neighborhood in identical $400,000 homes. The only difference is the piece of paper they signed. Sarah signed a 12-month lease. She paid a $2,000 security deposit, and her rent is exactly $2,000 a month. That is it. Clean, simple, and predictable. Her bank account is still full, and her weekends are completely her own. David took a very different path. He bought his house. To do that, he had to drain $80,000 from his savings just for the 20% down payment. Then the bank hit him with another $12,000 in closing costs. Before he even spent a single night in his new bedroom, David was out $92,000 in cold, hard cash, and the bleeding did not stop there. With a 6% interest rate, David's monthly mortgage payment for principal and interest is roughly $1,900. But that is not his real payment. When you add in property taxes and homeowner's insurance, David is actually writing a check for $2,500 every single month. That is $500 more than Sarah. Every 30 days, David feels the squeeze of that extra cost. On day one, the scoreboard is brutal. Sarah has her savings intact and a lower monthly bill. David is broke, stressed, and house poor. It genuinely feels like David made a massive financial mistake. By year 3, the gap between them seems to be widening. Sarah is living the dream. Her rent is still predictable, and when the air conditioning unit dies in the middle of a brutal July heat wave, she makes one quick phone call. Her landlord sends a repairman. The unit is replaced, and Sarah does not pay a single dime. Her financial life is a smooth, straight line. David's life is a roller coaster of hidden expenses. When his identical air conditioning unit dies the very next week, there is no landlord to call. He is the landlord. That replacement costs him $5,000 out of pocket, and that is just the beginning. Most people only calculate the mortgage payment, but the true cost of homeownership is buried in the fine print. Nationwide, the average homeowner now spends nearly $16,000 a year on hidden costs. That includes over $10,000 on maintenance and repairs, $2,000 on homeowners insurance, and $3,000 on property taxes. These are unrecoverable costs. David will never see that money again. It does not build equity. It does not increase the value of his home. It just vanishes into the walls of the house. When Sarah looks at David spending his weekends fixing gutters and writing massive checks for property taxes, she feels incredibly validated. She is keeping her money. David is bleeding cash. But this is exactly where the illusion is strongest. Because while David is paying for maintenance, Sarah is paying for something much more dangerous. By year 5, the story begins to quietly shift. At first, the numbers told one story. Now, time is telling another. Sarah opens an email from her landlord. It is time to renew her lease. But the rent is no longer $2,000. Historically, rent in the United States increases by an average of 3 to 4% every single year. Sometimes it is more, sometimes it is less, but it almost never goes backward. In year 2, her rent went up to $2,080. In year 3, it hit $2,160. Now, in year 5, Sarah is paying roughly $2,400 a month. The cheap, flexible option is slowly becoming a heavy monthly burden. Across the street, David is opening his mail too. His property taxes and insurance have gone up slightly, but the core of his housing cost, his principal and interest payment, is locked in. It is exactly the same $1,900 he paid on day 1. It will be $1,900 in year 10. It will be $1,900 in year 20. This is the turning point. Inflation is a slow, silent tax on Sarah's life, but it is actually working in David's favor. As the cost of living rises and their salaries increase over the years, David's fixed mortgage payment feels smaller and smaller relative to his income. Sarah's rent just keeps eating the same percentage of her paycheck. The gap in their monthly costs is closing fast. Now, if you ask a financial expert, they will point out a very specific argument. They will say that Sarah is actually the one winning, as long as she follows one golden rule: rent and invest the difference. The math on this is undeniably powerful. Remember that $80,000 David used for his down payment? Sarah kept hers. If she put that $80,000 into an S&P 500 index fund on day one and let it compound at an average of 8% a year, that money would grow into a massive fortune over a few decades. Furthermore, if she took the $500 a month she saved by not paying David's higher housing costs and invested that too, she could theoretically build more wealth than David ever will. On a spreadsheet, renting and investing often beats buying a home. But life does not happen on a spreadsheet. It happens in human psychology. The problem is that almost nobody actually does this. When Sarah saves $500 a month on housing, she does not usually log into her brokerage account and buy index funds. She goes on vacation. She upgrades her car. She goes out to nicer dinners. The money just evaporates into her lifestyle. David, on the other hand, is forced to save. Every time he pays his mortgage, a small portion of that money goes toward the principal. He is literally buying a tiny piece of his house every month. A mortgage is essentially a forced savings account with a roof. And for the vast majority of people, forced savings will always beat good intentions. Let us fast forward to year 10 and look at the final scoreboard. This is where the math gets genuinely shocking. Over the last decade, Sarah has paid rent every single month. Because her rent increased by an average of 3 to 4% each year, she is now paying close to $2,900 a month. When you add up all those payments over 10 years, Sarah has handed her landlord over $280,000. That is more than $250,000 gone forever. She has zero equity, she does not own the property, and her monthly housing cost is higher than ever. Now look at David. Yes, he paid a fortune in hidden costs. Over 10 years, he spent roughly $160,000 on property taxes, insurance, and maintenance. He also paid a massive amount of interest to the bank, but his principal and interest payment is still exactly $1,900. And here is the magic trick of home ownership: appreciation. Historically, homes in the United States increase in value by an average of roughly 4 to 6% a year. Some years are flat, some years spike, but over a decade, the growth is powerful. David's $400,000 home is now worth roughly $650,000. At the same time, David has been slowly paying down his loan. He now owes the bank less than $270,000. When you take his home's new value and subtract his remaining debt, David has nearly $380,000 in pure equity. He built a massive chunk of wealth simply by living in his house. The gap between them is staggering. The median net worth of a homeowner today is nearly $400,000. The median net worth of a renter is just $10,400. Sarah bought flexibility, but David bought a financial fortress. I would be lying if I said buying a house is always the smartest move. There are very real situations where renting is mathematically and practically superior. If you live in a hyper-expensive market like San Francisco or Manhattan, the math completely breaks down. In those cities, buying a home can easily cost twice as much per month as renting the exact same property. In that scenario, Sarah is not just saving $500 a month. She might be saving $3,000 a month. That is enough to genuinely build massive wealth in the stock market. Renting also wins if you plan to move soon. Buying a home comes with brutal transaction costs. Between closing costs, loan origination fees, and realtor commissions when you sell, it usually takes at least 5 to 7 years just to break even on a home purchase. If David gets a job offer in another state in year 3 and has to sell his house, all of his supposed wealth gets instantly wiped out by fees. The problem is not renting itself. Renting is a fantastic tool for buying short-term flexibility. The problem is treating a short-term tool as a permanent lifestyle. When Sarah and David made their choices, they both thought they were being smart. Sarah looked at her low monthly rent and thought she had beaten the system. David looked at his new house and thought he had secured his future, but they both made the exact same mistake. They based a 30-year decision on a 1-year time frame. The real trap is not renting, and it is not buying. The real trap is failing to calculate the cost of time. Renting means paying 100% interest on your housing forever. Buying means paying a heavy price today to lock in your housing cost for tomorrow. So the next time you look at a lease agreement or a mortgage document, do not just look at what it costs you today. Ask yourself one simple question. What does this actually cost me when it is all over? Because that is the only number that matters.